welcome back to my channel Accountancy. Continuing with the concept of journal, as we did in the last class about traditional classification of the accounts, we are continuing with the same, adding on few new things about the transactions as well as modern classification. Let's how the traditional classification is converted into the modern. Firstly, we're gonna see that. As we said, debit the receiver, credit the giver. As per the traditional classification, it is personal account. And debit what comes in, credit what goes out. As per the traditional base, it is real account. Debit all losses and expenses, credit all incomes and gains. As per the traditional, it is nominal account. Now, what is the modern version of the account? In the modern classification, the accounts has been classified only into the 5 types there, with nothing special names which we use in the common business. They are there, normal names are there. One is liability, second is capital, third is assets, fourth is expense, and fifth is revenue. Now nothing new have been put up there, just a diversion is there. We say whatever comes into the business is to be brought in by the owner himself or from the borrowed funds. Fine. So whatever is your capital or liability goes to your personal account. Okay? Then real account already told you that it deals with only the assets there. Then nominal account is about the expenses and about the incomes, that is expense and revenue. So as per the modern classification, we have liability, capital, asset, expenses and revenues there. 5 types are there, which are based on your traditional classification there. Now, let's have few transactions over here and understand these things from these transactions. First of all, Mr. X, who is the owner in the business, is starting his business with the cash brought into the business. Now, in this case, what is coming into the business is cash. And who is bringing, that is the owner. Owner's investment in the business is known with the word capital. Fine. So owner is the giver, so he should be credited. Fine. And what's coming in the business, that needs to be debited. Fine. So we will say for the first transaction here, which account is to be debited, that is cash account is to be debited because cash is coming into the business. And who is bringing that cash? Owner is bringing. Owner's name is not written in the books of account, rather word uses capital account. So here the word used, who is the giver, that is the owner, and for owner we make use of the word that is capital. So here cash account debit to capital account is there. Fine. Now the second transaction, Mr. X borrowed from Mr. M for business investment. To put some more money into the business, he has borrowed from someone outsider. So into the business, what's happening again, that is cash is coming into the business through the investment done by owner, but owner is investing that money by borrowing from someone. Now here giver is M, not X. X is borrowing money from M to bring into the business. In the business, money is coming from the borrowed fund, that is M's loan account here. M is lending money to here. If owner is investing himself, that becomes capital. If owner is investing through the borrowed fund, then it becomes the liability of the business. Both were the givers here. Owner himself was giving money to the cash. He is bringing money into the business by borrowed fund. Both were the giver of the money. That's why credit the giver rule has applied over here. Okay? I have told you as the modern also, as per the traditional also. Now the third case where he says that rent received in cash. Here again money is coming into the business, but money is coming for some particular income, that is rent. Here the rent is the income of the business. Now, one account is fixed that cash is coming into the business, so it should be debited, debit what comes in. In another version, when debit is coming into the business, who is bringing that cash? Here no one is bringing, rather it is generated through one income, one revenue of the business. Its name is rent. So we will name here why this income is generated. Why this income is generated? Because of rent. So income account is to be credited. Or there is modern classification that says the revenues are there. Now here revenue is to be credited. Fine. Now the fourth point goes with salaries paid to employees. Salaries have been paid to someone, that is employees. First of all, what is coming in or going out, that is cash is going out from the business. So one account is fixed, that is cash account, which is moving out from the business. Credit what goes out, cash is going out, that's why it has been credited. But what about the opposite account here? Which account is to be debited here? Here it is mentioned that salaries were paid to the employees. Now, employees are the receivers, but we won't write the name of the employees here because they are not directly connected. They are here to give in their services. For the services, business is making them payment on the basis of which expense name, that is salaries. Employees are not bringing in any goods. When the goods are there, then we name the party. If the goods are not there, assets are not there, we are paying someone for the services or receiving for the services, we will name it with the particular expense or revenue account. Here the name of the expense is the salaries account, so that is why salary account debit to cash account word would be there. Salary is the expense of the business and it needs to be debited here. Right? Now, let's again have a look about the things. When cash was coming into the business, we have debited it as per the real account. But when cash was going out from the business, we have credited it. When cash was going out of the business, we have credited it as per which account, that is real account. See, debit what comes in, credit what goes out. So it says that if in the business asset is increasing, it should be debited. In means increasing. When asset is decreasing, it should be credited. So cash in debited, cash out credited. Fine. So same goes, asset account would be debited when something plus is there. If something minus is there, it would be credited. Right. So here its account is mentioned that assets normally have which balance? Debit balance. Fine. Assets, because assets in the business are always in plus sign, so they have which balance? Debit balance. Now going along, about here, the givers were talking about these two accounts. Okay? The capital and the liability. Both were increasing in the business. Both were increasing in the business. Both were givers in the business. You can say also. Capital was coming into the business, M's loan was also coming into the business. Both are givers, so both of them, both are givers, so both of them are creditors. Fine. So both of them are credited. That's what the point is over here. So liability account and capital account have which balance? Credit balance here. Now, the leftover is about expense and revenue. Normally, you will see over here, when something is your income, then it is credited. When something is your expense, then it is debited. Right? So income is credited and expenses debited. So that means what? Expenses carry a debit balance and revenues carries a credit balance. So as per the modern classification, asset and expenses have debit balance and liabilities, capitals and revenues carries credit balance. That is for the day. We will continue with the more transactions and more classifications in the upcoming videos. Thanks for the day, Accountitude. If you like it, kindly subscribe and share and give your comment. If you want to ask something, you can put over there. Keep scoring. Thank you.